All right. Good morning, everybody. Can you hear me? And can you see me? Can you see? All right. Good morning, everybody. Let's just do that. Okay. Can you hear me? Yes? No? Can you hear me? Uh, yes? No? Um, oh, you can. Okay. Good. So, okay, we're good. Thank you, Shar. All right. So, welcome to the Pinnacle Institute and our session today on how to insure your financial investments. All right. My name is Steve Moses, and thank you, Eric. Appreciate that. Just wanted to, I'm technology and I are not on a first name basis, so I always never know if I'm doing it right. So if you can hear me and see me, that's always a good thing. All right. So we're going to talk about insuring our financial investments today. All right. And again, my name is Steve Moses, and I'm the options market specialist at the Pinnacle Institute. And we will talk about some of the upcoming workshops that we have for introductory and advanced traders. So we'll touch on that at the end of the webinar. So our topic for today is how to insure our financial investments. All right, and we're all familiar with the concept of insurance, but we may not be familiar with the concept of insurance as it relates to insuring our money. Okay, so a couple of quick things. I will ask throughout the presentation if things make sense. If you wouldn't mind just putting in the chat box if the answer is yes, if something makes sense, and just give me a yes or a no or a thumbs up. If it doesn't make sense, that's cool too. But I'd like for you to get out of the webinar today what you'd like to see. So, all right. Um, Before I get into into the topic, I do need to make sure we're all on the same page. And every event we do at Pinnacle, I need to just go through a couple of disclosures so that I under promise and over deliver and keep the attorneys happy, so nothing gets misrepresented in the marketplace. All right. First of all, the Pinnacle Institute is not a registered investment advisor. We do not provide personalized investment advice. We do not provide generalized investment advice. We do not give advice. Well, look, I'm originally from New York. I'm out here in California now, Napa Valley. The only advice I'll give you is don't wear a Red Sox hat at Yankee Stadium. But other than that, we don't give any advice. And any information that you see today or anything on the Pinnacle website is for information and educational purposes. Okay. And remember, there is no guarantee of success in the stock market, options, futures, Forex. There is no guarantee of any investment working out profitably, and you are responsible for any and all investments you make, timing to get in, get out, etc. All right. The FTC says that most day traders are not profitable. That doesn't mean they don't have profitable trades. It just means that they are not profitable consistently over time. And my favorite disclosure is all trading comes with risk. I mean, come on, guys. If there was such a thing as a guaranteed trade, if there was a trade that was guaranteed to make you a profit, would I be here talking to you? Okay. We wouldn't need the insurance, right? Actually, with today's topic, if there was such a thing as a guaranteed trade, we wouldn't need to be talking about how to insure your portfolio against loss. All trading comes with risk. There is no guarantee of success in the markets. And everything you are going to see today or at any point in the future on the Pinnacle website is copyrighted. No portion of what you see may be photographed, video recorded, audio recorded, reproduced, or retransmitted by any means on Facebook, Twitter, YouTube, Instagram, TikTok, etc. Okay? All right. Now, let's talk about insurance. Okay? If I asked who's got homeowners insurance, every hand's going up. If you own a home. Who's got car insurance? If you got a car, every hand's going up. Who's got boat insurance? You got a boat, your hand's going up. Who's got life insurance? Well, hopefully, you do. Okay. But these are the insurance policies that most people have. And by the way, just a little aside here. I mean, homeowners insurance. I mean, you have to have it if you have a mortgage. To be honest, if now you do need to have driver's insurance, but if you buy a house for cash, you don't need to have homeowners insurance. The only reason most of us regular people have homeowners insurance is because we don't own the house. The bank owns it, and they want to make sure that they're protecting their investment. So for most of us, think insurance policies: homeowners, auto, boat, life. One of the reasons I moved to Napa Valley a few years back is I've been a wine fan for about 35 years, been collecting wine. Back when I lived in New Jersey, I had a wine cellar with a lot of bottles. And I had insurance on the wine cellar in case the basement flooded or a tree hit the house, or I had teenagers and they brought their friends over and got into the cellar. And but you could insure anything, okay, against loss. Rumor had it back in the 1950s, the movie studio MGM insured Betty Grable's legs because she was one of the biggest stars at the studio if something happened to her. So think of insurance policies, okay? Now remember, an insurance policy doesn't mean you won't lose the asset. All an insurance policy means is if you were to lose the asset, financially, you would be made whole. Just because you have car insurance doesn't mean you're not going to have a car accident. Just because you have homeowners insurance doesn't mean your house ain't going to burn to the ground. And obviously, just because we have life insurance, I heard some comedian recently say, nobody's getting off the planet alive. We're all, our number is going to be up at some point. So just because you have life insurance doesn't mean you're not going to go. Okay. Now, if I asked you who has all of these, most of the hands are going up, obviously. However, if I asked who has IRA insurance or even stock insurance, how many hands would go up? Very few. Okay. If I asked you people who has insurance for all of those assets, you'd all say yes. But if I said who has IRA insurance, very few. The reason is most traders and or investors would say that IRA insurance or stock insurance doesn't exist. Okay. Now, they would say it doesn't exist. It's not available. Now, don't go calling State Farm and ask for the IRA insurance policy. Okay. But again, let's discuss the concept of insurance. If you have an auto policy and you total your car, okay, that is my car or was my car about 10 years ago. I got rear-ended on I-95 driving from Philly up to where I lived in Jersey. I got rear-ended while I was doing 65 miles an hour. Don't ask. I walked away without a scratch, but because the frame was damaged, the car was basically totaled. But if you have an auto policy and you total your car, what do you get? You get a check, right? Assuming your policy is current, assuming your policy is paid in full, assuming your policy hasn't expired. If you totaled your car, you did lose the asset, but financially you were made whole. Now, why do you get a check? Because the insurance company likes you? Because the insurance company feels sorry for you? No, you get a check because they're obligated. They sold you a policy, they collected a premium, and in exchange for collecting that premium, they took on an obligation to pay you if you crack up your car, to pay out if you file a claim. They are obligated to make you whole. Now, like I just joked, don't go calling State Farm tomorrow and ask for the IRA or stock insurance policy. It doesn't exist. Okay? Now, this is what a car wreck looks like on Wall Street. This is the financial equivalent of totaling your car. Now, by the way, this is the headline of USA Today on March 3rd, 2009. Now, if you remember back 12 years ago, the subprime, the movie The Big Short, the mortgage-backed securities mess, what took out Bear Stearns and Lehman Brothers, and everybody thinks the secret to the stock market is buy low and sell high. Well, there's nothing wrong with buy low and sell high. But remember, in order to buy low and sell high, other people have to buy high and sell low. All right. But usually, a lot of people end up selling near the bottom. And here's why. This was March 3rd of 2009. The market bottomed out. The S&P 500 dropped 55% from October 07 to March 09. Okay. And 6 days before the market bottomed out, this was the headline on USA Today. For investors, bloodbath reflects fear. And if you read the article, Dow hits 12-year low, closes under 6,800. How low stocks must go before bottoming out is anyone's guess. People are terrorized and throwing in the towel. Wealth is being destroyed on Wall Street at a rate not seen since the 30s. The NASDAQ was down almost 74%, the S&P 55%, and the Dow 52%. People see this headline, and what do you think they're thinking? Oh my God, America's going out of business. Well, 5 or 6 days later, the market bottomed out, and basically we've been in a bull market ever since, for the most part, okay? But this is the equivalent of a car wreck financially. Now, here is another thing that happens financially. Companies come out with earnings. That's the whole market in general. But this was in 2015. Now, Apple's a good company. I think you'd all agree, okay? Well, I was teaching a class somewhere, and there was a TV on to CNBC in the common area. And Apple had just announced their earnings at 4:30 in the afternoon, Eastern time. The market had closed, and this was the screenshot that I saw. Apple, this is what drives retail traders nuts, by the way. Apple makes billions and sells off. They just announced if I remember correctly, they just announced the second best earnings report in the history of the US, and the stock reacted immediately down over 5%, down almost $7 a share, down 5% after hours, and it gapped down further at the open the next morning. And 4 weeks later, the stock was at 90. Now, first of all, why did Apple stock tank on great earnings? Well, I can't answer that, but I'll tell you one thing, the stock was at a supply area. Having said that, let's say you owned Apple shares, and anytime a company comes out with earnings, there's a risk. Okay. PayPal or Peloton came out with earnings a couple of weeks ago. Earnings were great. Stock dropped 20 points, 25 points. Zoom, at the end of August, Zoom came out with earnings. The estimate was 81 cents. They came in with $1.36. The stock gapped down 25 points. And to this day, it's down 70 points in the last couple of months. So if you own a stock and you don't plan on selling it, and earnings are coming up or whatever other reason, okay, if you owned insurance, if you had a protective put option prior to the earnings announcement, think of that put as insurance for shareholders. Because what are put options? Now, assuming you're on this webinar, whether to the degree that you know options, if you want to put in the chat box your experience with options, there are basically two options, guys: calls and puts. Call options are like supermarket coupons. Call options give you the right to buy a stock at a set price, no matter how high it goes. Put options give you the right to sell a stock at a price, no matter how low it goes. Well, doesn't that sound like insurance? You have a $50,000 car, and I'm just using round numbers. You have a $50,000 car, and you have car insurance. Like my last picture, you total your car. It's worthless. You still get to sell your worthless car for $50,000. You had insurance. God forbid your house burns to the ground. It's worthless. You get to sell it for its insured value. Well, let's say when Apple was trading this day at 1:30 before the earnings announcement, okay? Apple was trading at 1:30 and you bought a 1:30 put option. Well, you have the right to sell Apple at 1:30 no matter how low it goes. Just like you have the right to sell your car for 50 grand if you total it, or your house for $1 million or whatever it's worth if it burns to the ground. Does that make sense, everybody? So a protective put bought prior to Apple's earnings announcement, think of stock insurance for shareholders, would have offset any loss incurred by Apple's 25% drop in the next month. And remember, the earnings were great. It was one of the best earnings reports in the history of the US. And yet the stock tanked. So again, you could be 60 years old, have never had a car accident in your life, never gotten a ticket, never had a car accident. You're a great risk to the insurance company. Doesn't mean you're not going to have a car accident tomorrow. Okay. All right. Now, Stock insurance doesn't exist. How do you protect the value of a financial asset? How can you protect the value of your retirement account? Put options, as I just explained. As we've discussed previously, when buying a put option, you're buying the right to sell a stock at a set price, a higher price, regardless of how much the stock drops, even after it drops. Okay? And there's your insurance policy. So say you owned 100 shares of a stock at 145 and you had reason to fear it dropping. You could buy a put option at the 145 strike price. You literally just bought insurance on your stock. Now, yes, you have to buy the option. You're going to pay a premium to buy the option. But guys, don't you pay a premium to buy your car insurance? Don't you pay a premium to buy your home insurance? You don't get insurance for free. Okay? So if you bought a 145 put option with your stock at 145, you literally just bought insurance on the financial value of your stock holding. You bought the right to sell your shares at 145, no matter how low it goes, even if the stock went to zero. Okay? So say the stock dropped to 115 a share. Why can you now sell a 115 stock for 145? For the same reason the insurance company is sending you a check for the value of your car or the insured value of the car, even if you totaled it. They are obligated. Okay? So if we're buying a put option, we're buying the right to sell a stock at a set strike price. And the seller, and the reason who's obligated, so let's say we bought a 145 put, the stock's at 115. Why can we sell a 115 stock at 145? Because the person who sold us that put is obligated to buy the stock from us at 145 if we exercise the option or if we file a claim. Think of it as if you exercise your put option, you are filing a claim. Does that make sense? Okay, so if your house burns to the ground, they don't send you a check unless you file a claim. If you total your car, they don't send you a check unless you file a claim. So if we buy a 145 put and don't exercise it, well, nobody's going to file the claim. Okay, we could sell the stock or we could just sell the put for a profit. And I'll talk about that in a second. Okay, if we're buying a put option, we're buying the right to sell a stock at a set strike price, and the seller of the put is obligated to buy the stock from us at that price, no matter how low it goes, if we file a claim. Okay, when the buyer of a put exercises the option, exercises their right to sell the shares, you're filing a claim. The seller of an option is taking on the risk to fulfill an obligation in exchange for collecting a premium. And by the way, if we total our $50,000 car, that's an investment the insurance company is losing on, because if they have to write you a check for 50 grand, but the insurance policy was only $2,500, I'm just making up numbers, they collected a $2,500 premium and they got to write a $50,000 check. So what does the insurance company do to mitigate their risk? They do their due diligence. If you want car insurance, they're going to say, give me your driving record. How many tickets, how many accidents? You want health insurance? Give me some blood pressure, some cholesterol, pee in a cup, any family history. Do you smoke? Do you drink? Blah, blah, blah. Okay? So the insurance company gauges the premium they're going to charge based on the perceived risk. We're going to do the same thing, but we're going to use supply and demand in what we're looking to do. Okay? Now, there are only two times a trader would buy a put option. You buy put options, you can buy a put option even if you don't own the stock. You can just trade options. Okay, and again, I don't know the experience level of people on the webinar. Okay, if you want to share this with me, but if you trade options, you never have to own stock. But the topic of today is for those of you who own stock. What is because the difference between trading put options as options and trading options as protected puts, if you're buying a protected put, you are buying an option out of the money to not lose money on your stock. If you don't own stock, you can buy put options in the money and just make a profit if the stock drops, just like selling short. You could sell a stock short at supply or resistance and make a profit if the stock drops. We can buy a put option and make a profit if the stock drops, or buy a call option and make a profit if the stock goes up. So as an options trader, you never have to own the stock. As an options trader, you never have to trade the stock. What we're talking about today is, for those of you who do own stock, how you can protect the value of that stock investment. Okay, so say the stock is at a supply zone or resistance, whatever you're using. Okay, and the expected directional move is down. The trader is looking to profit as the stock moves away from the supply zone. We will buy an in-the-money put, and just like selling short, and profit by the move down on the stock. But let's say the stock is at a demand zone and you own the stock. I'll give you another example. Roku. Earlier this week, Roku dropped to a demand zone last week. It was sitting in a demand area for about 10 days. And let's say you owned the stock and you bought the stock at demand, or you already owned it at demand, and you are looking for protection in case the stock breaks the demand zone and continues dropping. That is, actually, and a protective put could be purchased anytime a trader feels the value of a stock they own could fall. So let's say you owned Roku on Tuesday at $270 a share, and you bought a $265 put. Well, Roku is trading at $235 today. If you still own that stock, you're down $35 a share. But the value of the put that you bought, the value of the insurance you bought, would have increased dramatically, offsetting that loss. Does that make sense? Okay. So remember, the purpose of insurance is to not have to file a claim. I mean, when you buy insurance, do you ever hope you file a claim? Any of you upset your life insurance policy hasn't kicked in this year? I'm serious. You buy insurance hoping to never have to file a claim. What you're buying is peace of mind. You're really hoping you don't have, you don't sit there and go, gee, my car insurance expires tonight at midnight. I better hurry up and get into an accident so I can use the insurance. You hope to never have to file a claim, but you have peace of mind. Okay? So the purpose of insurance is to not have to file a claim. All right? Now, we buy the policy to protect our peace of mind. We all hate insurance companies. Until when? Until we need one. Until an asset we own has been damaged or destroyed, then we need the insurance to recoup the lost value. Okay? Remember, insurance doesn't stop the loss from happening. You still lost the asset. It just makes you financially whole. So while we don't want our stock to lose value, it's nice to know we can be made if it drops. So look at this example from earlier this year. If you own shares of McDonald's, okay, where you might want to buy your protective put is wherever your stop loss order would be. So in this example, let's say either right here where this wick is above where it says BTO, let's say you bought the stock right there, or this last candle here on the right. You bought McDonald's stock right here at about 205, okay, give or take. So if you own shares of McDonald's at 205 and you were willing to place your stop at 200 on a break below the demand zone, well, you could certainly place a good till cancel limit order to sell your shares at 200. Now, if the zone holds as expected, the stop loss would never be filled and you'd stay in the trade. However, as I just mentioned, Roku, Zoom, many stocks, last earnings announcement, Amazon gapped down 250 points. What if the stock gapped down to 150? While that's not likely, it is certainly possible. Okay? Protective puts can actually offer you more protection than a stop loss. Now, I'm not advocating that you don't have stop losses. I'm saying a protective put ultimately on a gap would protect you. If the stock doesn't gap, if this stock just came into the demand zone and just dribbled, a stop loss would get, executed and you'd be fine. Okay. But if the stock, let's say you had a stop loss on your stock at 200 and the stock gapped to 150, where are you getting stopped out? You're not getting stopped out at 200. You're getting stopped out at 150, which is a much larger loss than you were planning on. Now, assuming you position sized correctly. See, here's the thing. You bought a stock at, say, 205. You put your stop loss at 200. You're risking $5 a share. So you bought 100 shares. Your risk is $500. But then the stock drops 50 points. Uh-oh. That's a much larger loss than you were planning on. And by the way, while I said earlier, it's not likely McDonald's is going to gap down 25 points. 5 or 6 years ago, Chipotle stock had an E. coli scare. They shut 40 stores. And there was one day the stock gapped down 30 or 40 points. Okay. I mean, the stock went from 750 to 400 in 90 days. But the day the E. coli scare was announced, the stock tanked. Remember the day Johnson & Johnson, the news came out that the asbestos in the baby powder, and they knew about it for years before they did anything about it. The stock gapped down 20 points or something. So stuff happens, okay? While not likely and not probable, it happens. So protective puts can offer you more protection than a simple stop loss. And I'll show you the math in a second. If the stock gapped to 150, the 200 stop loss would be activated and the order would be filled at the open after the gap with the stock at 150, resulting in a much larger loss than the trader was willing to take when placing the initial stop loss order. And of course, unless you're day trading, now, by the way, if you had a stop limit order at 200, you're not even out of the trade at 150. That's the difference between a stop loss and a stop limit. I'm not really sure why people use stop limits, but if you had a stop limit order at 200 and it gapped from 205 to 150, you're not stopped out at 150 and it could keep dropping. But if you had a regular stop loss, okay, on anything other than a day trade, you'd get out at 150. But if you have a 200 put, we have the right to sell the stock at 200. Regardless of where it gaps down to or how low it might go. The stock could drop or gap to $10 a share, to a nickel a share, and we still have the right to sell it at 200 because the person who sold us the put is obligated to buy the stock from us at 200 if we exercise the option. Okay? The 200 put, the seller of the put is obligated to buy the shares from us at 200 if we exercise the option. We have a guaranteed buyer at 200. The seller of the put will get assigned and they will have to buy the shares from us at 200. Now, remember when I said insurance companies do their due diligence. So when you sell puts, you are actually acting as an insurance company. Now, why would someone sell a 200 put? Well, if they think the demand zone is going to hold at 205 and the distal line here is 202, they're not expecting the stock to get to 200. Just like if you've never had a car accident and never gotten a ticket, State Farm doesn't think they're ever going to have to write you a check. But accidents happen and stuff happens. So when we sell puts, we want to do our due diligence and sell puts where we don't think the stock is going to go. So the person who bought the put will never exercise it. We will never have to fulfill our obligation to buy the stock, and we get to keep the premium. And that's how insurance companies make money, guys. I mean, think about it. How does an insurance company make money? Buying insurance or selling insurance? Selling insurance. And they hope they never have to fulfill, honor a claim. Okay? So we have a guaranteed buyer of our car, if it was car insurance, if we total it. If the insurance company gets assigned, they have to fulfill their contractual obligation, which they took on when they sold the policy and collected our premium. Okay, now let's do the math. Let's look at how a protective put would offset any intrinsic loss if the stock drops. to 150, okay, the stock in this example, the stock is at 207 or 208, whatever it is, okay? If the stock closed yesterday at 207 and opened today at 150, you've lost $57 a share. If you had 100 shares, you lost $5,700. Ouch. And that's probably not the four-letter word I would use, but ouch. Okay. However, even if you own the stock, but you bought a 200 strike put and the stock is at $50, the intrinsic value of that put would be $50. We paid $7.50 for the put. We bought a 200 put for $7.50. That was the premium. Now remember, options are sold in contracts. Each contract gives you the right or obligation to buy or sell 100 shares. So if the option premium is $7.50, it would cost you $750 to buy the put option. Now, is that a good investment? Well, if you had 100 shares of stock at 205, that's $20,000 worth of stock. Is it worth spending $750 to insure $20,000 worth of stock? I think so, but that's up to you. Okay, so if the stock drops to 150, the 200 put has an intrinsic value of $50. Now, why is the intrinsic value $50? This is why you have to learn about options. Because if we have the right to sell a stock at 200, but the stock is trading at 150, in order to exercise the option, if you bought the stock at 150, sold it for 200, you're going to get $50. Okay. But you got to subtract the $7.50 premium you paid. So now your intrinsic profit on the put is $43. So right off the bat, you lost $57 a share on the stock. You've gotten $43 of that back. You've gotten almost 80% of your loss back just on the intrinsic value of the insurance. Does that make sense? Okay, if we bought to open a protective put when the stock was at 207, which was the proximal line of the demand zone, we'd lose $57 a share. However, the 200 put would be worth at minimum $50. Now, here's the thing. Depending on your experience with options, and again, I don't know anybody's experience level here, but until an option expires, when you trade options, you're not just trading the intrinsic value they're worth. Options have time value. When you buy an option, you're buying what it's worth and you're buying time. When you sell options, you're selling its intrinsic value and you're selling time. So let's say we bought an option that expired in 8 weeks and then the stock tanked. The option's going to be worth $50 intrinsically, but there would be remaining time value. And if you learn about volatility, how option premiums can inflate, if the stock is tanking, chances are the option premiums are actually inflating. Okay, so the $43.50 profit on the put option is only the intrinsic profit. And remember, we've already gotten back at least, at minimum, $43 of our $57 loss. And I know what some of you are thinking, well, then I'm not totally insured. Yes, you are. Because by the way, if you had a $50,000 car and you paid a $2,500 premium and they write you a check for $50,000, you really only netted $47,500 because you still had to buy the insurance. So if your car really is worth $50,000, you got back $47,500 of your $50,000 loss. Okay, so the $43.50 profit is only intrinsic profit. Okay. In addition to that, the put premium would have extrinsic value based on how much time was left until expiration. The faster the stock drops, the more time left until expiration, the greater the extrinsic value added to the $43.50 intrinsic profit. But wait, there's more. And this is something you have to learn if you're going to trade options. Option premiums options are the only asset class where you can make or lose money. The option premiums will inflate or deflate without the stock price moving. See, if you buy a stock at $50 today And in a month, the stock is at $50. No harm, no foul. You broke even. You shorted a stock today at $50. And a month from now, the stock's at $50. You broke even. You only make or lose money if the stock price changes. But with options, because you are buying or selling time in addition to the intrinsic value. So if a stock is trading at 50, that's the intrinsic value of the stock. You're not going to buy a $50 stock for 51, and you're not going to sell a $50 stock for 48. The stock price is the stock price because it's the stock price, and that's the intrinsic value of the stock. Options have intrinsic value, but they were paying for time. And option premiums can inflate or deflate based on the risk to the option seller, based on the risk to the insurance company, so to speak. Okay, so as implied volatility tends to rise or inflate as a stock drops, the inflating volatility would increase the put premium above the directional intrinsic value and in addition to the added time value. So if you do this right, if you buy a protective put, a combination of delta rising as the stock drops, increasing the intrinsic value of the put, and inflating vega means it is actually possible to see more profit on the put than was lost on the stock. If I come back to here, guys, and let's say there's still 2 months till expiration and volatility inflated, it is possible to have made more than $57 on the put. Now, I know I'm from New Jersey. Okay, and you think of The Sopranos, it is possible to make more on the insurance than you lost on the stock. In real life, that's called insurance fraud. But in the options world, we can really do that. It can work out. I've seen it work out that way because volatility measures fear. I mean, think about an insurance company. Let's say you have a house in Fort Lauderdale, right on the beach, and a hurricane's coming. What's going to happen to insurance premiums if you start asking for insurance quotes? The day everybody knows the hurricane's coming, the insurance premiums are going to inflate because the insurance company is taking more risk. Then the hurricane hits, there's no damage to your house, the insurance premiums deflate when the risk goes away. Well, it's the same thing in the stock market. Okay? The option premiums inflate or deflate based on the perceived risk of the option sellers, just like car and house insurance premiums inflate or deflate based on the perceived risk of the insurance sellers. Okay, so it is possible, if done right, to actually get 100% of your loss back and to actually even make more money on the insurance than you lost on the stock. And if the stock were to gap down to 150 and keep going, and here's the best part. What if the stock gapped down to 150? Your protective put is worth at least $43. And then you sold the shares at 150. You can keep the put. It is now no longer a protective put because you're not protecting anything. You sold the stock. But now you've got a put on a stock that just tanked. You stop the bleeding on the stock, and the put could, and if the stock keeps dropping, the put will keep adding value, and you can actually make a nice profit on the trade if that works out that way. Okay, so remember, it is possible to make more on the insurance than you lost on the stock. Now, strike prices. How do you select your strike price? Well, ideally, a trader would choose a strike price to buy the put at the price they would be willing to sell their shares. So, for example, wherever you would be placing your stop loss on the shares below the demand zone. Okay? Now, the closer to the current price, the more expensive the put will be. Now, one way to reduce the cost of the put, the cost of the insurance, is to buy puts further out of the money, further below demand. Now, the further the protective put is bought below the demand, the further the put strike is out of the money. Now, it will lower your premium, but it will also have the same effect as increasing your deductible on a car insurance policy. If you want to lower your car insurance premium, how do you do that? You raise the deductible, which means you're going to pay more out of pocket before you can file a claim if you have a car accident. So the 200 put example I mentioned would cost you $750. You don't want to pay $750, so you buy a 190 put. That's only going to cost you $425. But now if the stock tanks to 150, you don't get to sell the stock at 200. You only get to sell the stock at 190. You buy a 185 put, it's only 330. You buy a 180 put, it's 270. But if the stock was trading at 207 in my example, and you buy a 180 put, yes, you saved almost $500 on premium, but you also don't get to sell, but you're also going to lose $20 more before you get to file a claim. Does that make sense, everybody? So again, it's just like raising your deductible on your car insurance policy. Okay, so you have to determine where your stop loss is. Okay, and it's the same with expiration date. You need to know, so, I'm making this really simple today. We're talking about the concept here. I'm not teaching this today. So if you want to, trade options in general or look to, trade protective puts, let me ask you a question. When do most people find out they don't have flood insurance? Unfortunately, after the flood. You may think you bought puts to protect your stock position, but you may find out after the stock drops, after the flood, that you bought the wrong put at the wrong strike price or the wrong expiration date. Okay? And you may not be as protected as you thought you were. Okay? So, if you want to reduce the premium paid, you are also, risk reward, guys. It's all about risk reward. If you want to reduce the premium paid, you're also reducing the price we get to sell the stock at. So in a sense, you are reducing your insurance coverage. Instead of being able to exercise the put and sell the now 150 stock at 200, you'd only be able to sell the 150 stock at 190, 185, 180, whatever it is. You raised the deductible, taking a larger loss on the insured asset. Okay? Now, protective puts could be bought anytime a stock is owned. It doesn't have to be around an earnings announcement. Okay? You could buy that protective put at the time the shares are purchased. That is considered a married put, is when the stock and the put are bought at the same time, or any time a trader is looking to limit their risk on a long stock investment. Okay? And for those of you, anybody trade options? You can buy a protective put on a call option that you own. Now we're getting into certain option strategies. Basically, you can buy a put to protect any bullish investment that you have. So if you own the stock, you're buying a protective put. But let's say you went out and you bought a call option expiring in 2 years. You bought what's called a LEAPS option, which stands for long-term equity anticipation securities. Okay. Now, what's the benefit of buying a LEAPS option? Well, compared to buying the stock, you can buy a LEAPS option for a fraction of the cost of what it would have cost you to buy shares of stock. Okay. It's still, you're going out 2 years. It's still a nice investment. But obviously, if the stock tanks, your call option is going to get hurt, and you can buy a put option to protect that. Any bullish trade you're in, you can insure with protective puts. Okay? Now, by the way, how do you insure an IRA? IRAs, by definition, are not insurable. Now, here's how you would do this. Okay? Here in America, especially, if you have an IRA or a 401k, what is probably in your IRA or 401k? Mutual funds? Yeah, probably. Most Americans, now when I got involved into trading and investing in 2004, there weren't a lot of ETFs. They were brand new. And again, the thing that I would say 99.9% of Americans had in their retirement accounts were mutual funds. Okay. I mean, if you had a 401k, chances are the only choices your company gave you to invest in a 401k were mutual funds. And they may have given you 5 or 6 or 10 mutual funds to choose from. And you chose, I'll put 20% in this fund and 10% in that fund and 30% in that fund. And okay, you could allocate the percentage based on the fund. All right. But guys, as diversified as you think you are by going into different mutual funds, what's in a mutual fund? Stocks. So at the end of the day, even if you diversify your mutual funds, you're probably not as diversified as you thought you were. Because in 2008 and 2009, when the S&P dropped 55%, virtually every mutual fund dropped 55%. So how do you insure a 401k or an IRA that has mutual funds in it against loss? Because mutual funds are not optionable. Okay. Do you know what the SPY is? The SPY is the exchange traded fund that tracks the S&P 500. So if let's say the S&P 500 drops 20%, chances are most mutual funds will drop 20%. Okay. What if you bought puts on the SPY at the corresponding level of where the S&P was? So let's just say, and again, I forget where the S&P is right now. Let's say the S&P is at 4,600, okay, and the SPY is at 460, okay. If you bought puts at below demand, say at 440, okay, and the S&P started dropping, the value of those puts are going to increase, like I just showed you in the McDonald's example. Now, you may not be able to trade those puts in the same account where your IRA is, and you probably can't trade those puts in the account where your company 401k is. Now, just to be fair, when I got involved in this in 2004, you couldn't trade options or even stocks in most 401ks. You might be able to do that today. You need to check. If you have a company 401k, you need to check with your company on what the choices are that you can do. If you have an IRA and it is a self-directed IRA, see, when I got involved in trading in 2004, I had a financial advisor who managed, put me in mutual funds, and it wasn't self-directed. But if, I eventually I hate to say I fired him, but I eventually moved my IRA from all those mutual funds into a brokerage account, and I opened a self-directed IRA, and I haven't been in a mutual fund since 2005. Okay, so if I have my IRA at, say, mine's at Thinkorswim. So if I have my IRA in Thinkorswim, I actually can, in that account, buy put options. Okay, I can do it in the same account because it's a self-directed IRA. If your IRA is being managed by somebody else in account A, or you have a 401k with your company in account B, you could buy put options on the SPY in one of your accounts somewhere else, in another account. So technically, you would look at your P&L in your IRA and see the loss, but no, in the other account, that loss is being offset. Does that make sense, everybody? Okay, so if you're not sure how to do this, then you got to look into it. But in my, if I was still in IRAs in my Thinkorswim account, I could buy puts literally in that account. If the guy Danny was still managing my IRA at whatever mutual fund company he was managing 20 years ago, I could still trade buy SPY puts in my Thinkorswim account. And just know that whatever loss I took with Danny was being offset in my Thinkorswim account. Does that make sense, everybody? Okay. So, just understand. And by the way, so Danny was my financial advisor. Now, if you didn't know prior to an hour ago that you could insure your financial investments, well, and you have a financial advisor, shame on them. Because in order to become a financial advisor, you pass your Series 6, your Series 7, your Series 63, whatever licenses you have to get. In order to pass those tests, and they're not easy from what I've been told. I'm not a financial advisor, okay? But in order to pass those tests, you have to answer questions about options. They know what put options are. They know how options work. Now, that may not be a part of their business. That's not what they sell. And let's be honest, financial advisors, as good people as they probably are, they're in business to make money, as all of us are. I mean, I hold no, misconceptions there. And the way they make money is managing money. That's why they want us to buy and hold, and they get a percentage fee or a commission on the mutual funds. You ever wonder why your company 401k only gives you 10 mutual funds to choose from? Because on one level, some mutual fund companies sold their services to your company to manage the 401k. So you're only given those 10 mutual funds out of 1,000 or however many there are to choose from. Okay, so any financial advisor understands that put options could be insurance. In 2001, 2002, when the dot-com crash, 2000 to 2001, whatever it was, when the dot-com crash was going on, and I was fully invested in mutual funds, I remember calling Danny near the depth of the dot-com crash. I'm going, Danny, market's tanking. My account's getting killed. What should I do? He said, don't worry about it. Market's going down for everybody. I went, okay, that makes sense. Because that's what I thought. It's America, markets go down, everybody's losing money. He never said, A, we should sell the mutual funds because we're buy and hold investors, because both he and the mutual fund still collected a fee as long as I held and didn't sell. Yes, they got a smaller fee because the value was less, but they still got paid. Okay, and I didn't know you could make money to the downside back then. All right, but he also didn't tell me, even if he wanted to keep getting the fee, he never told me I could have bought put options. I could have bought an insurance policy to protect the value. And that would have been the prudent thing to do. And that would have been the win-win. He would have still gotten to collect the fee because I didn't sell the mutual fund. And I could have offset the loss. Now, yes, eventually the fund came back. But, by that point, I would have profited on the insurance, and then broken even. Then the mutual funds would have gone back up, which they did, which they ultimately ended up doing. Okay, same thing in 08 and 09. And guys, here's the thing: I'm not one of these guys, screaming the world's going to end, the world's going to end, the world's going to end. But is the market going to tank again at some point? Yep. I don't know when. If I did, I'd be backing up the truck somewhere. Is the market going to tank again? Sure it is. All right, maybe tank is a strong word. Will the market crash? Will the market correct? Will the market, if you study history, come on. We are in an incredible bull market right now. Some people don't understand why, with all the money the government's printing, blah, blah, blah. I don't want to get political, whatever. But at some point, every market crash was preceded by an all-time high. Now, markets have been setting all-time highs for a couple of years now, so it could be next week, next month, next year, 2 years. But something's going to happen, okay? I worked with a member a few years ago. I had a guy in one of my classes. His name was Mel, and he was 94. I'm like, dude, what are you doing here at 94? Why aren't you, on the veranda, with a beverage and a cigar? And he said, frankly, I didn't think I was going to live this long, and I can't afford the market to crash. I can't run out of money. So, what he was wanting to learn how to do was what we're talking about today. He was there to learn how to protect what he had. This guy didn't want to day trade. He actually said to me, Steve, I'm 94 years old. I have arthritis. I couldn't click the mouse that fast enough to day trade. I just can't lose 30, 40, 50% again in a year and a half if something were to really hit the fan. Okay, because by the way, at my age, if it comes back, I may not be here for that. Okay, he had a good attitude about it. But I'm just saying, guys, any financial advisor you have, they know what puts are. They know what the concept of protective puts are. Learn about options. I think options are the greatest thing ever invented. We can use options as protective puts. We can use options where you don't want to buy the stock. Stocks you can't afford to buy, you can buy call options for a fraction of the price of buying the stock. You can get into options trades and be wrong directionally. There are bullish options trades. The stock can go down and you can make a profit. There are bearish options trades. The stock can go up and you can make a profit. You can be wrong just not really wrong. You can't be Enron wrong. Okay? Because options are the only asset class that have time value, that have extrinsic value, that the premiums will inflate or deflate without the stock price moving. Okay? And for our purposes today, we focused on the protective nature of put options. So if you own a stock, if you own mutual funds, if you have a financial stake in the market, you can protect that against loss. And by the way, if you are in bearish trades, if any of you have ever sold stock short, or if you have traded options and you are in bearish options trades, you can buy protective call options. See, a protective put, if you own stock, your risk is to the downside. But if you're in bearish trades, your risk is to the upside. There's always a way to quote unquote hedge or protect what you have. All right. But you got to learn. I mean, look, I was only kidding before about when do most people find out they don't have flood insurance? Unfortunately, it's after the flood. Okay. You want to go for health insurance after you've been diagnosed with something. You hear about pre-existing conditions all the time. Okay. Guys, I think everybody needs options because for the reasons I just mentioned. You can profit off the movement of a stock without ever having to buy the stock. You can make a profit off of Amazon and risk less than $5 a share, even if the stock goes to zero on certain credit spreads and certain options trades. There are so many reasons why everybody should have these option arrows in their quiver, why everybody should learn options. If you're a stock trader or a mutual fund investor, then what we talked about today was protective puts. So if you have any interest, come join one of our workshops coming up. Okay. I do the introductory Pinnacle workshops. We got one tomorrow morning, one on Tuesday, one on next Saturday. We have advanced workshops for those of you that might have some experience with supply and demand, experience with trading. You get to work with Sam Seiden and come join us here at the Pinnacle Institute and learn how options can be traded for profit or for protection. Or for income, or for wealth, or for whatever you want them for. So thanks for joining me today. Again, my name is Steve Moses. My email is steve.moses@pinnacleinstitute.com. So it is the 21st century. You can email Moses. There's a link in the chat box to some of our upcoming workshops. So by all means, if this is of any interest to you, in these workshops, we talk about in the introductory workshop for Pinnacle, I talk about what makes the price of stocks and markets and assets and futures and Forex go up and down. We talk about how markets really work. So come join us for, a no-cost introductory 90 minutes on how markets work and then maybe how some of these leveraged assets can help you. So next week is Thanksgiving. So if you are with me here today in the U.S., have a great weekend. Have a great Thanksgiving. Next month is Christmas and New Year's. Be safe with COVID and fires and droughts and all the climate stuff. Be well, be happy, be healthy, and hopefully I'll see you in one of our workshops. Thanks for joining me today, and be well. Talk to you all soon. Bye-bye.